Okay, so why don't we move on and talk about one of the biggest mistakes that we see in the real world, and that is when the trust is a beneficiary um, and the underlying asset is an IRA or a retirement plan. In this situation, you have some very, very specific conditions that the trust must follow, or you end up with a massive taxation of the beneficiary, not because of the Secure Act, but just because of the federal tax rules if you don't meet all these conditions in the trusts. And what we have found is that the majority of trusts that we see where the underlying asset is an IRA violates at least one of these conditions. Now, I'm not saying that the IRS is going to necessarily audit you and figure that out, but who wants to have their kid live under the specter that if the trust wasn't drafted right, that there could be a massive estate tax? And again, more than half, it used to be like 90% of the estate attorneys got this wrong. Now they're doing a little better, but it's still more than half get this wrong. There's a lot of reasons that you might want to have a trust. You might have a spendthrift. You might have a kid who's an alcoholic or a drug addict, or you might have a kid who's a doctor or a lawyer or somebody where you want creditor protection. So there's a lot of good, or you might have a young beneficiary, like a grandchild, who you don't want to have unrestricted money for the grandchild at 21. So there's a lot of good reasons to have a trust. And it's very possible, particularly if you're IRA heavy, that the underlying asset that will go into the trust at death is the IRA. And this is what is typically botched. And real quick story. So I was reading the Wall Street Journal one day, and it said, it's very complicated to draft a trust when the underlying asset is an IRA, which I agreed with. So the conclusion was, if you have a big IRA, don't name a trust, name a individual beneficiary. I thought, that's terrible advice. There's so many good reasons that we might want to have a trust as the beneficiary. And the right answer isn't to name the wrong beneficiary, which could be an individual. The right advice is to just find an estate attorney that knows what they're doing and knows how to draft when the underlying asset is an IRA. And I get all flustered and annoyed, and I write out a letter to the Wall Street, the editor of the Wall Street Journal. Dear Wall Street Journal, I read your article that said when the underlying asset is an IRA, that you shouldn't name a trust as the beneficiary of the IRA, that you should name an individual. And I strongly disagree with that advice. The better advice is just to find an estate attorney that knows how to draft a trust when the underlying asset is an IRA and it meets all the conditions. And I think that you should print a retraction. Sincerely, Jim Lange. So anyway, that day, this was when I had a radio show, I had a noted estate attorney. He's still around, by the way. He still does great work, and he's a common speaker. Really good guy, too. His name is Bruce Steiner, and Bruce was the visitor on the show. And, I started out with a little bit of chit-chat. Hi, Bruce, how are you? I'm furious. Well, what's the matter, Bruce? He said, today there was an article in the Wall Street Journal when it said when the underlying asset was an IRA, that you shouldn't name a trust as the beneficiary of the IRA. And that's the exact wrong rules, the exact wrong advice. What you should do is find an estate attorney that knows what they're doing, knows how to draft when the underlying asset is an IRA for the trust. And that's what you should do. And I was so mad that I wrote a letter to the Wall Street Journal. Probably pretty close to the one that I wrote. Needless to say, they didn't publish either of our letters, and they didn't make a retraction, but it's a very, very common mistake, and it's something that you shouldn't do. It's much better to just go to an estate attorney that knows what they're doing. And in our assets under management role, and I don't know anybody who does this, partly because we just have the capability, and partly because I just like to get everything right. And to me, retirement and estate planning is almost one word. It's a continuum. And if you're going to look at somebody's retirement plan, I don't know how to not look at their will and their beneficiary designation. And since more than half the time they botch it, we want to be in a position to say, hey, you botched it, you have the wrong language, go back to the estate attorney or use a different estate attorney or use this language. Now, we're not allowed to draft for non-Pennsylvania residents, but we are allowed to make recommendations, and we do that. And sometimes we've provided more value for clients, helping them with their estate plan, even if they're not Pennsylvania residents, because getting it wrong can be so expensive, and it can potentially be the difference of hundreds of thousands of dollars. And it's routinely done wrong. Now, to be fair, it's not routinely caught, but who wants to have the specter of the IRS if they catch, and by the way, it could be years after you're gone, they find that the trust was not drafted properly, and boom, your kid ends up with a big income tax acceleration. So you want to get that right. Then I told you that charitable trusts now take on a new meaning for two reasons. One, the Secure Act, because the Secure Act taxes and accelerates the income taxes on the inherited IRAs, not over the life of the child, which is what the old law was, but within 10 years. Charitable trusts, or CRUTs, charitable remainder unit trusts, now take on a new meaning and new benefits as beneficiaries of IRAs and retirement plans. And they now deserve serious attention. And so I've been writing about this actually even before the act came out, because we knew that these were going to be one of the exceptions. But the question was, how much money goes to the kid and how much money goes to the charity? And a lot of times, if you ran the numbers, it was a little bit better off if you just named the kids outright and you didn't mess with the charitable trust. Now, with the 75/20 rate so high, what that means is the kids can get a much higher annual distribution, leaving a lot. And basically, the way this works is the kid gets, quote, an income. Let's not get into the definition of income, but let's say that gets a distribution. And then when the kid dies, whatever's left goes to the charity. Well, if the kid's getting a lot more, the charity ends up with a lot less. So this becomes more and more favorable, even if you're not that charitable. Now, we have run numbers. We haven't redone the numbers for the new rates, but it would be even much more favorable. But the kid gets income. When the kid dies, charity gets the rest. The actuarial value of the charity is 10% of the value of the IRA at death. But in order to calculate that, they say, what is the 75/20 rate? And it used to be very, very low, which means the kids couldn't get a big income, but now it's much higher, which allows a higher income for the kids. And you might say, well, gee, if the kids are only getting, if the charity is going to get 10%, even if the kids are getting a higher amount, how can this be better? And the reason is because it's an exception to the Secure Act, so you don't have that huge income tax acceleration. For people who are actually charitable, it works out really well. But even for people who are not, and again, it's going to vary on a situation by situation basis, it could be very good. Under the old rates, it wasn't that great for most families. Under the new rates, it's becoming more and more interesting. So another really interesting area. Another advanced technique. Who gets what? Why isn't everybody doing this? It makes so much sense. Let's start with the low-hanging fruit. You want to leave $100,000 to the XYZ charity at the second death between husband and wife. What do we see probably 95 or even 98% of the time? After my wife, and this is typically in a will or a revocable trust, and it applies to after-tax dollars. After my wife and I die, or after my husband and I die, I leave $100,000 to the XYZ charity. So what happens? The family, and let's forget about inheritance tax, which might be nothing or it might be inconsequential. The family gets $100,000 less, okay? Charity gets $100,000, but the charity doesn't care in what form they get money. To them, whether they get an IRA, a Roth IRA, after tax, they don't pay taxes. They just want the highest amount. So what if we switch who gets what? Instead of leaving after-tax dollars to the charity, meaning that the kids get $100,000 less value, what if we provide for the charity, not in our will or revocable trust that applies to after-tax dollars, but to the IRA? So we leave $100,000 pre-tax to the charity. Again, they don't care because they don't have to pay tax. So then what are the kids out? Well, they're out the $100,000 in the IRA, but $100,000 in an inherited IRA, let's keep it simple and say taxes are $24,000, that they're only out $76,000. So we actually just saved a quick $24,000 by switching who gets what. Who took the brunt of that? The IRS. Why isn't everybody doing that? We hardly ever see it. I just did a talk for a charitable group where I said this should be standard. And again, I hardly ever see it. Another time, who gets what? Let's say you have two kids. Let's keep it simple. One's in the 12% bracket, one's in the 32% bracket. So there's a 20% difference in tax brackets. Well, if you leave everything equally to all the kids, you're going to have the kid in the low bracket get the Roth, and the kid in the high bracket get the traditional IRA. So kid in the high bracket's paying a big tax on the inherited IRA. The kid in the low bracket, even though he's getting some tax-free in the Roth, it's not all that valuable to him because he's in a really low bracket. What if we kind of switch who gets what? Now, there's a little bit of an art to get to typically you want to equalize more or less. But what you might end up doing is let's say you leave the Roth, the after-tax dollars to the kid who is in a high bracket, and you leave even more money in the IRA to the kid in the low bracket. And if you have a 20% savings, and let's just say it's on $1 million, that's potentially a $200,000 savings, and that is worth a few of the complications. All right, now, if it's not, let's say the difference is between the 22 and the 24% bracket. I'm probably not going to mess around because it's too much aggravation and too many moving parts to save too little money. But if I could save a couple $100,000, even if I don't get it 50-50 exactly, and by the way, Matt Schwartz kind of figured out a pretty nifty way of getting it as close to 50-50 as you can in terms of value. But if we can save $200,000 all at the expense of the IRS, that's something that I am interested in looking at. And we have recommended and done that for clients. I hardly ever see anybody do that. Why not? Well, anyway, we think it's really cool. And there's a lot of people who have kids who are in significantly different tax brackets for whatever reason. Okay, I already talked about the charity. I did it ahead of the slide, so that's why I'm skipping through this section. Okay, so I believe that we have time for about 2 questions before we wrap up. So Erica, can I have maybe about 2 questions?
Absolutely. So one question came from Stephen, and he asked, how could you use disclaimers if one of your desired beneficiaries is a charity? Funds could never bypass the charity in a beneficiary designation.
Why can't funds go to a charity? No, I leave money to charity all the time. If you looked in my own documents, I leave the money to my wife first. My wife doesn't want money to go to the charity unless she's gone too. And we do have a child with a disability, so we're not as generous as we otherwise might be. But I have beneficiaries in my own documents, not after-tax dollars, but IRA dollars going to charity. In fact, that's sometimes we don't do a Roth conversion just so we can have IRA dollars going to charity. So I'm going to challenge the question by saying that the assumption isn't right, and we leave money to charity through IRAs all the time. I wish we did it more. I wish we had more people who were wanted to leave even more money. Now, if you're going to leave $5,000 to charity and everything else to your family, maybe it's not worth all this fooling around. But if you're going to leave $100,000 or better yet, $1 million to a charity, yeah, it is worth fooling around. Because if we can have a substantial tax savings of using who gets what, either because certain money goes to charity, certain money doesn't, certain money goes to the weaker kid financially, certain money goes to the stronger financial to the kid. And basically what you're doing is, it's still a big pie, right? You can't do anything to make the pie smaller or larger, but if you take out a big slice of the pie that otherwise would have gone to the IRS, and then you can divvy the slice that used to go to the IRS, either to the kids or the charity, well, that's great. So why don't we take maybe one or two more, since that was a quick one.
So Steve asks about, he was wondering the pros and cons of using a corporate trustee for managing the assets of a trust that contains an IRA that was potentially created for protection against creditors or a spendthrift purpose or something.
Okay, so let's assume for discussion's sake that you have a good reason, whether the underlying asset is an IRA, retirement plan, after-tax dollars, whatever it is. And let's assume that obviously you can't have the beneficiary be the trustee. So it has to be somebody else. When it really comes down to it, the choice is going to be either a family member or a professional or corporate trustee, whether it's the US Bank, whether it's Mellon Bank, whether it's TIAA, whether it's one of the smaller trust companies, et cetera, et cetera, et cetera. I'm a little bit of a cheapskate, and a lot of times the corporate trustees will charge a percentage. And by the way, same issue, by the way, on who's the executor. A lot of times the corporate executors will charge a percentage of the estate rather than how much work it was based on a fair hourly rate. And by the way, a lot of state attorneys do that too. In fact, in Pennsylvania, if you hear an estate attorney say, "Oh, we just use the schedule," that's because there was a case called the Estate of Johnson. The judge said, "Here's the top percentages that I can stand. And if the estate attorney charges any more than this percentage, then we have to take a serious look at it." So then the estate attorneys say, "Okay, that's the standard schedule." And to me, that's just not ethical. If you have a couple $1 million estate and a fair, based on a fair hourly rate is, I don't know, $20,000 or whatever it might be, and the percentage is $100,000, why should the family have to pay $100,000 to an estate attorney to go through probate? And it's a mess. So I prefer typically, I don't like percentage charges for either executor or trustee. The bank is typically going to charge a percentage. I have used corporate trustees if A, there isn't a family member who you trust. B, I tend to use corporate trustees if you have a difficult beneficiary. So let's say that you have two kids and the one kid's really difficult. And it is relatively predictable that your two kids are going to fight about money if you name one the trustee for the other. Well, maybe I'm willing to sacrifice some fees, et cetera, just to keep the kids happy. Let's say that the spendthrift says, "Hey, guess what? Good news, brother. I got a job across town, so I'm not going to have to hit the trusts as hard. Isn't that wonderful news? But by the way, I need a reliable car to get across town. Do you think that I could use some money from the trust to buy a car?" Brother says, "Yeah, that seems reasonable." And he says, "Well, great. I was just at the Lamborghini dealers," and then they fight about that. And then at the end of the fight, "Oh, by the way, Christmas is at my house this year." So I'm very sensitive that I would I would typically rather avoid a fight, even if it ends up being more fees. On the other hand, very frankly, we have a family member as a trustee for our own daughter. which we think is appropriate. We trust her. We think she won't charge as much, and she will have personal relationship and will know what's going on our daughter's life. If you have a family member who would work, great. If not, you might be stuck with a corporate trustee. Why don't we take one more, and then we will talk about some of the ways that people can take the next step.
Great. The next question is from Steve, and he asks, does Jim use scenario planning or sensitivity analysis to address potential consequences of future uncertainty? I believe this is in the context of developing estate plans.
Well, so first of all, I don't know if he's referring to Monte Carlo, which is more of an investment on how much money will be there, or if he is, well, what if this person dies first? What if that person dies first, et cetera, et cetera. My default, if you have the right fact situation, is to build flexibility into the plan and let the survivor make that decision. On the other hand, sometimes we don't have that. And sometimes you have to say, well, if this person dies first, then this, if this person dies first, then that, if the kid is this, then the kid is, if this, if that, et cetera, et cetera. So my first preference, if possible and advisable, is to build in flexibilities. Other than that, you have to sometimes think about, well, what can happen? And you build things in based on what you know. And I like to try to prefer to build in something that is going to have a long shelf life, just because most people don't redo their wills every couple of years, no matter what the experts say, they just don't do it. It's not pleasant thinking of our mortality. It's not cheap. So they just kind of get the wills done. And by the way, it's been my experience, a lot of times people come to me, oh, Jim, it's time for us to update our documents. It's been 10 years, 12 years, or sometimes even more. And they think the biggest problem with their documents is that they're dated. And I would say the biggest problem with the documents that we've looked at is not that they're dated, but that they weren't done optimally on day one. So that has been our real life observation. But why don't we talk a little bit about what we have talked about? We talked about some of the bedrock principles. Don't pay taxes now, except for the Roth, except for the going from the taxable to the tax-free environment. We talked a little bit about the Secure Act basics, talked about the best estate plan for most, let's call it Leave It to Beaver married couples after the Secure Act. We talked a little bit about charitable remainder trusts and how they are a much more interesting option, both after the Secure Act and after the 75/20 rate went up. We talked a little bit about who gets what, which again, hardly anybody does. Actually, I don't think we did talk about gifting ideas, so I lied. So let's say that you say, okay, Jim, these are some great ideas. What happens now? Well, you can kind of figure it out on your own, or go to the same estate attorney that didn't do any of these or didn't do all these recommendations that I'm talking about. Or that can be one portion of the Retire Secure consultation. Now, again, if you're a Pennsylvania resident, we can draft all these documents. If you're not a Pennsylvania resident, we can't draft, but we're allowed to review your documents. In fact, we do. By the way, every time I do a Retire Secure consultation, I do ask for the wills and the trusts and the beneficiaries, and I look at them myself before I even get on the call. And I might say, hey, well, it's hardly ever done right, to be honest. I mean, it's pretty rare when I say, oh yeah, what you have is perfect. I wouldn't change one word. Very rare. Sometimes there's minor transgressions. Sometimes it's major. And sometimes it's relatively major but common, like not doing who gets what. That's, even though to me, particularly if the savings are $100,000 or $200,000, I call that major, but it's pretty common. But that's just one thing that we look at. And then we talked earlier quite extensively about Roth IRA conversions, And, I love our team. I love our number crunchers. I think I add a lot of value. The estate attorneys, the money managers. I think that we all add a lot of value. So the consultation, if you're a dyed-in-the-wool do-it-yourselfer, very frankly, I would rather spend time with people who are looking for some help. I'd love to, have a lower minimum. Frankly, if all I cared about was money, I would probably have a higher minimum. But we do have $1 million as a minimum for assets under management. If all you care about is portfolio performance, I think we do really well, and we're smart, and we protect people. When I say we, I'm really referring to the money managers, and they do asset allocation, asset location. But if that is your main concern, and you don't see any of the possibilities for saving money, we're not a great fit. We're really more for people who can appreciate some of the strategies, even if you don't see every detail, but can see, oh, gee, this can save $100,000. If this strategy can save $200,000, if making a Roth IRA conversion of the after-tax dollars inside the IRA can save $200,000 or $300,000 and it doesn't cost us a cent, well, gee, maybe it's worth paying an advisor to both one person who would manage the money, and then our firm who would do this financial master plan and do all these really cool things. So you can decide if that makes sense for you. But again, I'm a strategy guy. I'm a chess player. I'm a bridge player. I love strategy. I love helping people save hundreds of thousands of dollars. If you have a child with a disability, then it's even more important because, so our daughter is going to be $1.9 million better off. Well, if I didn't get it right, and our child ran out of money and she couldn't provide for herself, that would truly be tragic. So obviously helping people is a very good thing. And you say, well, gee, how are you different than any of the other money managers? Well, they don't have typically a team of highly experienced number crunching CPAs. They don't have, most estate attorneys don't know the stuff that we know, and don't have the math background. Matt Schwartz has a math degree from Northwestern. They're not into these IRA strategies. They're not creating financial master plans for you and your family. And it's just a different deal. And, I think, it's maybe not shy, but I think during our consultation, I provide a lot of value. Sometimes I can just say one thing, oh, gee, never thought about making $1 million gift. That ideal loan could save more than $1 million in taxes for some people. So having this really good team directed by me, good estate attorneys, good number crunching CPAs, good money managers, I believe is very often worth way more than 1% or whatever the charge would be, depending on how much money was invested. We are a team approach. We talk to each other. We argue with each other. We look, the estate attorney is looking at the spreadsheets for the number crunching, who is also looking at the financial advisor's recommendations, et cetera, instead of, you have the CPA here, you have the estate attorney here, you have the, what am I missing? Oh, the financial planner here, and they don't talk, and it ends up being a mess. And so I think that we're like the best team out there, the dream team, if you will. And we of course do annual reviews, which we think is very important because sometimes we just reiterate what we already said. Sometimes there's changes, and we have to take that into account.